Right now, 3M is up against a lot of litigation headwinds, including the ongoing earplug lawsuit, where so far they've had to pay out millions of dollars in damages, as well as another lawsuit involving hazardous chemicals that could reach up to $30 billion in damages in a worst-case scenario. Now, the combination of these lawsuits plus other inflation and supply chain headwinds is leaving many wondering whether the 3M juice is even worth the squeeze anymore. And if you don't feel good about buying this company with the risks attached to it, then I have two high-growth alternatives for you to consider that have actually delivered much better returns than 3M and could make for better long-term investments. So without further ado, let's get into it. All right, guys, now the first stock I want to talk to you about is one that I actually have in my own portfolio. And like 3M, this is a company that's been around for a long time. We're talking about SnapOn, ticker symbol SNA. Now, SnapOn is a manufacturer of high-end tools and equipment that are used by serious professionals in various industries, ranging from automotive and medical devices to military and mining. And SnapOn tools, guys, are one hot commodity. As far as tool brands go, SnapOn would be what Prison Mike would call the belle de ball. These tools are known for being extremely high quality and extremely long lasting, and therefore are heavily sought after, but with that, they do come with a higher price tag than what you'd find from some of their competitors. Now, like I mentioned just a moment ago, I am a SnapOn investor, and I'm also actually a 3M investor. I have both of these stocks in my portfolio, and as you can see, one is definitely performing better than the other. My SnapOn position is up about 5.5%, and my 3M position, guys, is like my portfolio's worst performing position, down over 28% with 3M. And if we take a look at the performance of both of these stocks, zooming out across a longer period of time, across 10 years, we can see that SnapOn by far is outperforming 3M. SnapOn is up about 200% in the last 10 years compared to 3M, about 26.5% in the same amount of time. So with that, if you would have invested in SnapOn over 3M in the last 10 years, you would have made a considerable amount more money. It's not even close. Now, it is important to mention that because one of these stocks is going up in share price and one of these stocks is going down in share price, one is getting closer to being in discounted range, which is important for us dividend investors. And if we compare the valuation stats on both of these companies, SnapOn on top, 3M on the bottom, we do see that 3M does have the lower PE ratio. It does appear to be at the better valuation with a PE ratio of 11.6 versus SnapOn's PE ratio of 13.75. And although 3M's is a little bit lower, a couple points lower, I've got to say a 13.75 PE ratio is really not bad. It's technically a little bit higher than 3M, but still in its own right, 13.75 is very affordable. Now, moving on and comparing the dividend stats between these two companies, I've got to say that both of them do have different things to offer. As you can see, we have SnapOn's dividend stats there on the top. We have 3M's there on the bottom. Just starting with the yield, I will say 3M does have the advantage as far as dividend yields go, sitting at just below 5%, where SnapOn's is like about half that, about 2.5%. But with that, it's important to remember that the reason 3M's dividend yield is so high is because that share price has been pushed down. A higher dividend yield is certainly enticing, but there's a reason that the dividend yield is higher, guys. More risk, more reward. Now, going back over to the dividend stats, guys, the next two metrics we're talking about, SnapOn just completely blows 3M out of the water. Their payout ratio is about half of what 3M's is, okay? And the 5-year growth rate sitting just under 15% is like 3 times the growth rate of 3M. And I will say this last metric, the growth history, 3M does have the obvious advantage, 63 years of consecutive dividend growth versus SnapOn's 12 years of consecutive dividend growth. I mean, having that dividend king status is certainly nice, guys, but you know, SnapOn is actually doing really good in the dividend department. Their consistency, believe it or not, is off the charts. Since 1939, SnapOn has paid consecutive quarterly cash dividends without interruption or reduction, a claim few public companies can make. Now, speaking of dividend growth histories, this next stock we're talking about most definitely has that in abundance. Not unlike 3M, this next stock, guys, is a dividend king. We're talking about Lowe's, ticker symbol LOW, which actually carries a lot of 3M products in their store. Now, I'm also a Lowe's shareholder, guys. This is a company I recently added to my portfolio, probably just a couple of months ago now, a few months ago. And as you can see, guys, just like with SnapOn, Lowe's is definitely outperforming my 3M position. My Lowe's position is currently up just over 4%. I have nearly 11 shares of Lowe's compared to 3M, which, like we saw earlier, is down nearly 30%, and I have just about 12 shares of 3M there. And looking at this chart right here, it's probably going to come as no surprise to you guys to see Lowe's completely dominating 3M. In the last 10 years, Lowe's is up nearly 600%. 600%. 100% on the share price compared to 3M, which is up, like we saw not too long ago, up just about 27%. So the return you would have generated investing in 3M over the last 10 years really doesn't even hold a candle to what you would have received investing in Lowe's. And even despite Lowe's really impressive share price performance, the PE ratio and the comparison between this PE ratio and 3M really is not too bad either, guys. As you can see, Lowe's has a PE ratio of 14.91, just under 15, compared to 3M's 11.6. And yes, 3M does have the lower PE ratio. They do have arguably the better valuation compared to Lowe's. But although the PE ratio is a bit higher for Lowe's compared to 3M, I think you're getting a better bang for your buck, especially when you consider the return you can get investing in Lowe's versus the return you'd get investing in 3M. It just doesn't even compare. Now, moving on, getting into the dividend stats, we can see that 3M yet again does have the advantage in terms of dividend yield goes, just under 5% compared to Lowe's, which is just above 2%. So quite a spread there. Like with SnapOn, the payout ratio for Lowe's is considerably better than 3M. 60% for 3M's payout ratio compared to just above 27% for Lowe's. So a lot lower, a lot more room to grow, and that's exactly what Lowe's is doing with this dividend. Look at that 5-year growth rate, 18.77%, which is impressive in its own right, but when you compare that, guys, it's crazy. 5% versus 18, almost 19%. And the dividend growth histories are pretty comparable as well. Like we mentioned a moment ago, Lowe's is a dividend king with 58 years of consecutive growth compared to 3M, 63 years of consecutive growth. And now moving on, guys, I want to take each of the three stocks we've kind of talked about in this video, 3M, SnapOn, and Lowe's, and run a little back test to see, number one, how much money you would have ended up with if you would have started investing in all three of these companies 10 years ago to today. And number two, I want to compare the dividend income you will have generated from investing in all three of these companies across that period of time. So to dive into this, guys, let's jump over to the screen. All right, guys, now what we are taking a look at here is the backtest portfolio tool on portfoliovisualizer.com. And I've already input all of the variables for this little example here that we're running. And as you can see, we're going to start this thing off in 2012 at the beginning of 2012 and then end it year to date in 2022. The initial amount contributed to this little, to each of these three positions is going to be 10 grand each. And then for each of these, you're adding $100 every single month. And as you can see, we've got 100% into 3M in portfolio 1, 100% into SnapOn portfolio 2, 100% into Lowe's portfolio 3. Now, if we scroll down, it will actually tell us the final balance of each of these three portfolios across the last 10 years. So we have in position number 1, 3M, whose final balance starting with 10,000, final balance being about $34,500. SnapOn, starting with the same amount, same everything, you would have ended up with just under $80,000, so quite a bit higher, about $45,000 higher than what you'd receive with SnapOn. And then lastly, Lowe's, okay, almost $135,000. So you would have ended up with $100,000 more investing in Lowe's than you would have 3M in the same amount of time. And now, so far, just talking about share price performance and the final balance in your portfolio, obviously, Lowe's is the winner, SnapOn's in second. 3M, it just doesn't even compare. You would not have been as well off investing in 3M compared to these other two stocks. But let's go back over to the screen real quick. We need to take a look at the dividend income. All right, so this is the dividend income that would have been generated across the last 10 years. If we go to this last full year in 2021, we can see that in that last year, in 2021, you would have brought in about $1,500 in dividends from 3M. Not bad. You would have brought in about $1,770 from SnapOn, so a couple $100 higher, and you would have brought in about $1,880 from Lowe's. So almost $400 higher than what you would have brought in from investing in 3M. So really, guys, all across the board, both in terms of share price performance and in terms of dividend income, you would have made more money investing in SnapOn and Lowe's compared to 3M. And you know what, guys? These are not just the only two stocks you should be looking at. Check out this next video right over here where I tell you about some more dividend stocks that have delivered just insane market-beating returns. All of the stocks in this next video are really great companies, and you're not going to want to miss these. So click right over here, and I'll see you in the next one.